Why do people lose money in the stock market? Introduction. The stock market is often seen as a vehicle for wealth creation, yet a large percentage of investors end up losing money. In the United States, the stock market is a crucial component of the financial system. However, both novice and experienced investors sometimes suffer significant losses. So why do people lose money in the stock market? There are many reasons, and this article will explore these factors in detail. 1. Lack of financial knowledge. Many investors enter the stock market without a basic understanding of financial literacy. In the US, especially after the pandemic, commission-free trading platforms like Robinhood led to millions of new investors entering the market. However, many of these new investors lacked knowledge of fundamental analysis, technical analysis, or market psychology. This often resulted in poor stock choices and major losses. Stock market investing requires serious research and knowledge. Investors must analyze company balance sheets, income statements, and sector trends. Moreover, understanding why a stock rises or falls is crucial. Unfortunately, many investors rely solely on rumors and speculation, leading to financial losses. 2. Excessive use of leverage. Leverage allows investors to trade with much more capital than they actually have. In the US, margin accounts and options trading enable investors to take on significant leverage. However, when things go wrong, this can lead to substantial losses. For example, during the GameStop GME stock surge, many investors made huge profits using leverage. However, once the stock crashed, many lost their entire capital. History has shown that excessive leverage can quickly drive investors into bankruptcy. 3. Short-term thinking and impatience. A large portion of American investors focus on short-term gains. Despite the success of long-term investors like Warren Buffett, many people try to make quick money. However, while the stock market trends upward in the long run, short-term volatility can be extreme. Impatient investors often panic during market fluctuations and sell at a loss. For instance, during the 2020 pandemic crash, many investors sold their stocks in great companies at low prices. A few months later, these stocks recovered, and patient investors who held on to them benefited. 4. Failing to understand market psychology. Stock market movements are heavily driven by investor psychology. Fear and greed are the two most influential emotions in the market. During the 2008 global financial crisis, many investors sold their stocks in panic, only to see the market recover later, missing out on potential gains. Additionally, herd mentality causes many investors to buy stocks at their peak due to hype. When a stock surges, many investors rush to buy in at high prices. However, when it starts to decline, they panic sell at a loss. 5. Market manipulation and speculation. Market manipulation is a common occurrence in the US stock market. Small investors often suffer losses due to manipulation by large hedge funds and institutional players. For example, stocks like AMC and GameStop, meme stocks, were hyped up by retail investors on Reddit. However, large hedge funds counteracted these movements, causing the stocks to crash and leaving many retail investors with heavy losses. Despite regulations by the Securities and Exchange Commission, SEC, market manipulation remains a reality in trading. 6. High-frequency trading and institutional players. Wall Street's biggest investment banks and hedge funds use high-frequency trading HFT algorithms to execute trades in milliseconds. This gives them a significant advantage over retail investors, who often find themselves at a disadvantage due to rapid market shifts. 7. Poor stock selection and lack of research. Many American investors rely on social media tips or word-of-mouth recommendations, rather than conducting proper research. However, thorough fundamental analysis is essential for making sound investment decisions. While major companies like Apple, Tesla, and Microsoft have historically performed well, poor timing or a lack of diversification can still lead to losses. 8. Ignoring interest rates and macroeconomic factors. The Federal Reserve's monetary policies, especially interest rate decisions, have a massive impact on the stock market. In 2022, the Fed's interest rate hikes caused significant declines in technology stocks. However, many investors ignored these macroeconomic signals and suffered losses. Conclusion: losing money in the stock market is often a result of multiple factors: lack of financial knowledge, speculative behavior, misunderstanding market psychology, ignoring macroeconomic factors, and poor investment strategies contribute to investor losses. Those who adopt a long-term perspective, conduct thorough research, and diversify their portfolios tend to perform better in the stock market. As Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." If you want to avoid losses in the stock market, education, discipline, and patience are your most valuable assets.